In 2020, Mitsui and Company was at an important turning point. The world had just been hit by the pandemic, commodity markets were unstable, and the stock market was treating many Japanese trading houses as if they were old cyclical businesses with limited future value. But behind the scenes, Mitsui was doing something more interesting. It was trying to prove that a trading company could become a much better compounder of capital. If Warren Buffett was looking at Mitsui at that time, he would not have been buying the headline story. He would have been buying the discipline. He would have seen a management team trying to lift earnings quality, control risk, improve capital allocation, and return more cash to shareholders. That is the real story of Mitsui from 2020 to 2026. At the start of this period, Mitsui still had a strong connection to commodities. Energy, metals, and resources were important engines of profit, but they also made the company vulnerable. When commodity prices rose, the earnings looked powerful. When they fell, the market quickly remembered that Mitsui was cyclical. So the big question was not just whether Mitsui could make money. The question was whether management could make the business less dependent on the cycle. From 2020 onward, the answer was increasingly yes. The pandemic test. The first test came in 2020. That year was the perfect stress test for any Buffett-style investor. Markets were panicking, global trade was uncertain, and many businesses were scrambling just to protect cash. For Mitsui, this was the kind of environment that separated real management quality from good luck. Instead of acting defensively in a narrow way, Mitsui kept focusing on long-term portfolio quality. It continued to think about where earnings would come from over several years, not just the next quarter. That matters because Buffett never buys a company just because the current numbers look cheap. He wants to see whether management behaves like owners, and Mitsui was increasingly behaving like owners. The company kept focusing on capital discipline, on maintaining a strong balance sheet, and on making sure growth investments had a purpose. It was not trying to chase every opportunity. It was trying to build a more durable earnings base. Around this time, the market started to notice something else. Mitsui was not just earning money, it was returning it. The company became more visible as a shareholder-friendly capital allocator, with a stronger emphasis on dividends and buybacks. For Buffett, that is a major signal. It says management is not hoarding capital for empire building. It is trying to raise per-share value. Why management quality mattered. From 2020 to 2026, the key question was never just, did Mitsui make more money? It was, did management make the right decisions with that money? The answer appears to be yes. Management focused on three things that Buffett cares deeply about. First, it kept pushing for operating earnings growth. That means the business was not standing still, it was finding new sources of profit and improving the quality of the existing ones. Second, it stayed shareholder-oriented. Mitsui increasingly treated capital as something that should be deployed only if returns justified it. When the stock was attractive, it bought back shares. When cash was excess, it paid it out. That is the behavior of a management team that thinks like owners. Third, it handled commodity exposure with more discipline. Mitsui could not eliminate cyclicality, but it could manage it better. Instead of being trapped by the cycle, it used the good years to strengthen the balance sheet and support better long-term capital allocation. That is how a cyclical company earns investor trust. The buyback story. One of the clearest signs of Mitsui's management quality during this period was its buyback policy. Buybacks are not automatically good. They are only good when the company buys back stock at a sensible price and does so with discipline. Mitsui's buybacks from 2020 to 2026 generally looked reasonable. In the earlier part of the period, when the stock was still cheap, buybacks were especially attractive. Later, even as the stock rose, Mitsui still kept returning capital in a disciplined way. That matters because Buffett's standard for buybacks is simple: repurchase stock only when it is below or near intrinsic value. Mitsui's behavior was broadly in that zone. It did not seem to overpay recklessly. It used buybacks as a serious capital allocation tool. That is one reason the Berkshire relationship mattered so much. Buffett did not just like low valuations, he liked management teams that would treat shareholder capital with respect. Mitsui fit that pattern better and better. The earnings engine by 2026. By 2026, Mitsui's profit profile had become much more mature. It was still a trading house, and it was still exposed to commodity cycles, but it was no longer just a commodity story. A meaningful share of earnings came from businesses that were more recurring and less dependent on raw material price moves. That is important because it tells you what management had accomplished over 6 years. It had made the business less fragile. A good way to think about it is this. In the early years, Mitsui's earnings were more tied to the cycle. Later, the company built more earnings from non-commodity businesses. That gave management more freedom to allocate capital intelligently, and that made shareholder returns more reliable. For a Buffett-style investor, that is exactly what you want. You want a company that can survive bad years, invest through good years, and still compound per-share value over time. Did they achieve their goals? Overall, yes. Mitsui's management from 2020 to 2026 can fairly be described as successful. They improved the quality of earnings, maintained strong discipline, returned capital aggressively, and kept the business moving toward a more balanced structure. Not every year would have looked perfect on its own. Commodity cycles still moved around. Profits still depended partly on external pricing conditions, but that is exactly why the scorecard matters. The question is not whether the company is cyclical. The question is whether management used the cycle well, and Mitsui largely did. It used the strong years to strengthen the company. It used buybacks and dividends to reward shareholders. It kept investing in businesses that supported future earnings. It did not simply chase growth for its own sake. It tried to create sustainable value. That is why Buffett could feel comfortable owning it. Buffett's view. If you look at Mitsui through Buffett's eyes, the answer becomes clear. Buffett likes 3 things: cheap valuations, good businesses, and management that acts like owners. Mitsui gave him all 3. The company was not perfect, it was not a pure consumer brand, and it was not a simple, predictable compounder, but it had enough cash generation, enough discipline, and enough strategic improvement to make it attractive. That is the hidden lesson from 2020 to 2026. Mitsui did not need to become a different company. It needed to become a better version of itself, and that is what it did. It became less dependent on commodities, more disciplined in capital allocation, more willing to return capital, and more credible as a long-term compounder. That is how a trading house earns a Buffett investment.